So it's really important that as you make decisions when you're looking for opportunities, that you make smart decisions and get into good properties, good opportunities, good investments, because it is so much easier to buy real estate than it is to sell a bad deal that you wish you could get out of.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Augustino. When it comes to real estate, opportunity doesn't always knock, as the proverb says. Rather, opportunities need to be discovered. This is especially true of multifamily real estate. You really need to hone your abilities to recognize an opportunity when you find one. Well, today's guest understands this very, very well. He's acquired over $500 million worth of real estate over his 30-year career, including over 3,000 multifamily units and more than 700 single-family homes, all with the assistance of proprietary software that he wrote himself. He has subdivided land, built homes, and constructed self-storage, but really prefers to reposition existing multifamily properties. As the president and CEO of Praxis Capital, he and his team have over $200 million in assets under management with a focus on acquiring underperforming residential real estate assets in growth markets so they can transform through renovation and through repositioning. He's also the author of Hands-Off Investor, the investor's guide to investing in passive real estate syndications. Now, with all that, I'd like to welcome Brian Burke to the show. Brian, thanks for coming on, bud.
Thanks for having me on. It's really a pleasure to be here.
Yeah, it's going to be great. Now, if you like what Brian has to say, you can reach him via the contact page at their website, praxcap.com. And if you like our content, please don't forget to leave a comment and rate the show. It helps us out tremendously when you do. Finally, if you text the word freedom to 202-410-4202, you get our free ebook, The Bulletproof Guide to Finding a Broker. Okay, Brian, go ahead and tell the listeners about today's marketplace and really how you find opportunities when you're looking at deals these days.
Finding opportunities is somewhat like finding a needle in a haystack, right? I mean, there's properties to buy everywhere, but that doesn't mean that they're an opportunity or even a good deal just because they're available for sale. So, it's one thing to find something to invest in. It's another thing to find something good to invest in, and that's really what's been difficult as of late. The market has changed quite a bit since 2019. Employment picture is much different. Rent growth pictures are much different. Collections are much different. So with all that stuff in mind, when you used to look at a property and think that you could forecast 5 or 6 or 7% rent growth, you can't look at it that way right now. You got to look at things with maybe even negative rent growth for the next 12 months and see if the deal still pencils. So really the challenge is finding properties that represent opportunity much more so than just finding properties. And we've been at this for about 30 years now, and I've employed a variety of different strategies to find opportunities throughout different market cycles and different phases of the cycle and so on. Started out finding everything I bought at foreclosure sales at the courthouse steps, buying all cash at auctions. And then moved in to the multifamily sector, where almost everything we buy comes through brokers, and those broker relationships really is the key to finding opportunities in multifamily.
Oh, especially these days. I think just like you said, now more than ever, there's tons of deals out there. The majority of them are garbage, so for lack of a better term. and it's really just finding those opportunities, so it sounds like we do it the same way. We find them through those broker relationships. But I think you'd probably agree that cultivating those relationships and really curating those friendships is what they eventually end up becoming is super, super important, right? When you're meeting and trying to build credibility with the brokers that they're the gatekeepers to the deals more than likely, right?
Yeah, it's true. And, those relationships aren't anything you build very quickly. And, it's interesting. You hear people all the time say like, yeah, I've never bought a property, but I've got this great relationship with a broker. It's like, well, you probably think you have a great relationship with that broker, and they're probably leading you to believe that you have a great relationship. Because maybe they need you to buy their worst deals because they know that their real relationships aren't going to. So you really have to try to sort out what your level of relationship is with that broker. And, this is a lesson I've learned the hard way over the years. When I first started in this business, I used to think, oh, I've got all these broker relationships and I can call them on the phone and they'll take my call. And that was a really good thing. But, you really learn the importance of that relationship when they call you and say, hey, I'm going to fly all the way across the country to come have dinner with you. And then I'm flying home. And that's the only reason I'm getting on this plane. That's a different level of broker relationship than they'll just take my phone call. So if they aren't getting on an airplane to come out and see you, don't think that you've got the greatest relationship, because I guarantee you they're getting on airplanes to see some of their other clients.
You know what? That's totally true, right? So we do training, we do mentoring as well, and one of the things that I often point out is that if if you're getting a deal, like you being a student out there right now, or someone getting a deal, and you never dealt with that broker before, all of a sudden they're throwing a deal your way. Why? That's the first question you ask yourself, is why are they
Yeah.
sending it to you, right? Because just like you said, they've already sent it out to their top one or two customers or one or two clients, and if they don't like the deal, then it goes to the next, like say five or six people, and if they don't like it, then it goes to then it goes to the masses, right? And if you're one of the masses, chances are it's probably not a good deal.
Yeah, well, that's kind of back to your point earlier that you made where you said that there's a lot of deals out there, but a lot of them are garbage. And brokers know that, but they make their commissions by selling real estate. So, to do their job effectively, they need to have a whole team of clients, and so, a team has a quarterback and a team has, all these different positions. And you don't know what position you play necessarily, but if you're playing one of those like substitute players, that's usually on the bench, then that means you're probably not getting the best deals.
Yeah. Yeah. Now, obviously, you've been at this for quite a while now, so you've already built some good, strong relationships with the top tier brokers in a variety of different markets, which is very, very key for those of you guys listening out there. It's the top. Every market has a top one or two brokers, and then there's some brokers that have different focuses on different asset classes and different size of assets as well, and that's okay. Your job as an investor is to figure that part out. Now, you, Brian, you've built up a huge, huge Rolodex, so to speak. There's an old term, right? Rolodex of brokers out there. But how do you build those relationships? Like say you were starting out from scratch, right? And say someone's listening. What would be your approach in today's world, in today's market, given, now compared to 30 years ago, there's gurus in every street corner pushing out all kinds of programs. And it's a very, very competitive world. How would you do it?
Well, the first thing is to just be humble, and the second is just to be yourself. And when I say that because the gurus will teach you, call the broker and speak their language and, talk to them like you're a bigwig and all this other stuff. Uh, and you got to remember that these brokers receive dozens and dozens of calls on a daily basis from people who will probably never buy a property from them, and they have to be able to manage their time, and to manage their time effectively, they're going to decide who they're going to spend time on and who they're not. So rolling in there like you're this big hot real estate investor, and you've been to this guru course and all this other stuff isn't going to score you a ton of points with the broker. What's going to score you points with the broker is to just be honest, be who you are, be yourself. uh, Discuss with them what your criteria is, what your buying criteria is, and how you're getting your funds to close those escrows. And that's what's really important. Is there's a lot of buyers out there that don't have a nickel, and they're calling brokers and like, I'm going to buy all these deals from you. And the brokers want to know how you're going to do that. So have your capital lined up in advance. Know who your investors are. If you've got the money in your checkbook, then that's great. Tell them, hey, I've got cash. But if you're raising money from other investors, have your capital lined up. Get everybody on board with your plan. There's always this thing where people say, what comes first, the money or the deal? Well, if you don't have the money lined up, you're not going to get the deal unless it's a really, really bad one. And the broker knows, like, hey, this is the only shot we've got to get this thing sold. Maybe it goes all the way through, maybe it doesn't, but nobody else is going to buy it. You don't want to be that guy.
Right. Right. And there's plenty of those deals out there. And um, there's so many of those deals out there that you, as an investor, for those of you guys listening, is you just really need to be careful, especially when you're getting into those first deals that maybe you are great at lining up that money. Make sure you're looking at the right opportunity, right? And which probably leads me to the next question: is that what sort of things are you looking for when you are looking at deals? Then, right? What sort of things are you looking for in a certain market, for instance, that makes you decide that, you know what, I really need to own this deal? Like, how do you come up with, or what does your criteria generally look like?
Well, it used to be our criteria was we wanted to generate a specific return, right? And if we could get the deal to pencil and we could generate that return, then that was really interesting to us. And what you come to learn over time is sometimes you can find a deal that you can pencil to those returns, but it's just in an area where it's just the juice isn't worth the squeeze. So
Mm.
what we found is that we really prefer owning properties that are in areas that are likely to perform very well. And so we're looking at things like median income relative to rental rates. We're looking at things like school rankings. We're looking at crime rates. We're looking at rent growth forecasts and occupancy forecasts and absorption ratios, construction to absorption ratios, and how much new product is coming online, and how many new jobs are being created in the area, how much population growth is there in that city and in that neighborhood. We're looking at all of those things that form the basis for the fundamentals of the real estate. And if we can get something that passes all of those initial tests, then we move on to underwriting the financials and see if we can get the deal to pencil. And penciling might mean something different. Now the returns might be only a 13 or 14 IRR, whereas before we wanted a 15 or a 16. Sometimes the tortoise and the hare, the tortoise wins the race. So we're watching a lot more for those tortoise style deals.
Yeah. Well, I think one thing that you've realized, and I've realized the same thing, is that, yeah, when you're first starting off, you're trying to maximize your investor returns, but I think it comes at the expense of dealing with a very different type of tenant and a very different type of asset class and a very different type of area that you don't want to be in long term. That maybe there's a lot of overheads, a lot of drama that comes with it. And I think as you start scaling upwards, those C minus properties and C properties, you really want to start shifting more into the B pluses and the Bs. It's far less drama. Maybe, and you're right, the returns are not as juicy as the stuff like that, the C level, but you're at least getting peace of mind, right? Which is totally worth it.
Yeah, and these days, in the face of economic uncertainty, the more that you can do to mitigate your risk, the better. And so, the different classes of property carry different risk profiles. And while a C property might have juicier return, or at least project juicier returns, whether or not you achieve them is another story. But assuming that they do have juicier returns, they come with a bit higher risk, and that higher risk means they may perform and they may not perform. The nice thing about properties in the B class is I think they're going to be the class of the field in the face of the current economic uncertainty. So I think they carry a lower risk profile. A properties, on the other hand, are kind of a medium risk profile. It's interesting. They're generally considered to be the lowest risk, but right now they have a little bit of risk from new inventory and supply side risk. But that is probably short term and will bounce back really quickly. In 1 or 2 years, we probably won't be thinking too much about supply side risk on the Class A front.
Yeah, no, you're absolutely right. I mean, we're actually going to be building up some A class stuff. I'm working on a big project right now. It's going to be over 400 units, and that's going to be. We're still going to be 2 years out before that's completed from today, right? Minimum. So, but you're absolutely right. You really have to be careful with playing with that type of asset class. But I think for most people listening, yeah, it's going to be I think most indicators I'm doing, they starting in the C's and D's, even, which I've never done D's, but shifting more towards the B's because you can get that consistent return, right, on a fairly stable asset, which is huge in this business.
Yeah, and in previous downturns, my observation has been that the Class C properties were the last to fall. The A's and B's would fell first, and the C was the C was the last to fall, and then the C is also the last to come back
Hmm.
because it just takes more time. The A residents' jobs come back first, and then their jobs support the jobs that are typically held by the tenants of Class C properties. And so, C is usually the last to react, both on the downside and on the upside. What's interesting about this economic situation that we're in right now is C was actually the first to fall. The service sector took the majority of the hit after the coronavirus shutdowns in an almost instant hit, and became the first one to suffer. And it'll also be the last one to come back. So C is a tough space right now. A's and B's though certainly seem to hold a little bit more promise right now.
Yeah, yeah, yeah. I mean, would you say that it also depends on the area as well? Like what areas that you're buying these C class assets?
Well, everything is area dependent, and real estate is always a local business. And it's always funny when people ask me, what do you think of the real estate market? And my first reaction is always, well, there's no the in it. That's what I think of the real estate market. There is no the. There's what do you think of real estate markets? Now, that on the other hand might be a more accurate question because there's a complete difference in the real estate climate between Phoenix, Arizona, and Baltimore or Chicago or some of the Rust Belt cities. Night and day difference in the way real estate is performing right now. So there's a lot of different factors at play. So certainly area and location will play a role in whether those C assets may perform or not perform.
Right, right. And speaking of that, so what areas are you guys currently targeting, and what areas are you currently in?
Yeah, so we target areas where people are moving to. So, we're looking at population migration patterns and looking for those places that are seeing that influx of population and that influx of jobs. Those are the two primary criteria. So right now, and actually for a considerable amount of time, that's led us to very similar locations. The every year we go through this exercise of looking to see, what markets are good and what markets aren't. And it's interesting because year after year, it's the usual suspects. And, we might add one and drop one off. And, there's a little bit of movement. But by and large, for at least the last 5 years, the list has looked pretty much the same. And that list has been Arizona, such as Phoenix and Tucson, great markets. All of the major Texas metros were really good markets for us, although I'll go back to that because we backed out of that for the moment. Uh, Georgia, like Atlanta, Georgia is a great market. Florida, Orlando, and Tampa have been great markets. Orlando, less so right now. Las Vegas was a great market, less so right now. The Carolinas, the Research Triangle area, Charlotte, great markets. Nashville, Tennessee. Our current portfolio is all Arizona, Texas, Georgia, and Florida. So I mentioned a couple of places that are kind of a little bit interesting because things are changing. Las Vegas was a great market, but right now it's hit pretty hard as a result of job losses from COVID with the high tourism component. Orlando is the same way. So they're going to see some short-term suffering, but long-term, when you start getting past the post-COVID era, there's some really interesting looking rent growth forecasts for the future in those markets. Vegas more so than Atlanta, actually. Texas has been a primary market for us over the years, but as of late, we haven't been focusing on it nearly as much. Houston was probably the one city where we owned the most real estate up until we sold our last property there in March. And now it's suffering a little bit from oil price declines, which have created some white collar job losses. Rig counts aren't expanding. That sort of stuff is creating a little bit less job growth there and some negative rent growth. So it's kind of off the list for now. So, the list tends to move around a little bit, but what we're looking at is what's good right now and what do we think is going to be good 1 to 2 years from now? Because let's face it, this year and probably next year, not much is going to look all that impressive.
Right, right, right. No, I think the same way. Now, what are your general thoughts then with all the people that are really leaving some of these blue states as well? Like, not to turn this into a political discussion, but that's a very real thing in our world where we really have to be careful with places, even down to the zip code level where we're buying, right? Because it could vary or could really impact how an asset's managed and if we want to be in that area, right? I mean, I know mass egress from California and New York, especially, is impacting some of the markets you just pointed out.
Yeah, my office is based here in one of the bluest states there is, and that's California. But yet, I won't buy anything in California. There's no reason to buy anything here. Yes, we do have outward population migration. That's not the only reason not to invest here. The regulatory climate is unfavorable. The tax climate is unfavorable. There's a constant drumbeat of rent control, eviction controls, and all sorts of landlord regulation that are coming down the line that while they may not have passed yet and maybe have even failed in the past, because of the constant drumbeat, you just never know when they're going to show up and appear. And we don't want to be caught in the middle of that. So we're completely avoiding California. There's no reason we'd ever buy anything in New York. I do own a property in Buffalo. But upstate's a little bit different than like New York City. But again, we're looking to buy properties where people are moving to and avoid properties where people are moving from. And whatever the color of the state is, if people are moving from that state, then that can equal a declining population, and a declining population is always, and I mean always, a headwind to rent growth. And if rent growth is what determines asset value, and increasing asset value is what drives return, and it does to some extent always, why fight the current? There's two different ways you can travel in a river. You can travel upstream or you can travel downstream. And if you're in a rowboat, I can tell you which one of those two directions is going to be a lot more easier for you.
Exactly, exactly. Now, but part of it though is finding the right data, and I think for many of the listeners out there, we all get our data from the same place, right? It's going to be citydata.com. It's going to be Zillow. It's going to be the usual suspects, right? How do you use different tools when you're looking at different areas? Because there's been times when I know in a certain city, for instance, that there's growth occurring, yet the data is reporting something contrary to what's actually happening, which actually works out well for me because I know what's going on in the market. Just because I'm there, right? I'm very, very familiar with what's happening. Are you using different tools when you're trying to figure this stuff out, or are you using pretty much the same tools everybody else is?
Yeah, I've probably been on city data maybe 2 or 3 times in my career. So I found that the free websites aren't all that productive for me, and so I use a combination of things for high level information, just kind of an overview. There are free resources out there that I found to be accurate enough to give you an idea of where you might want to be and where you might not want to be. And one of the things that you can do is just go onto Google and search for top population growth cities or top job growth cities, and you'll find links to articles on Forbes or Chief Executive Magazine or wherever, where they'll say here's the top 10 population growth cities, and they'll even link to the Census Bureau data where that came from, and kind of break down, like, if you just went to the Census Bureau's website and wanted to sift through their data, good luck. I mean, if you're a statistician, maybe that is something that would be interesting to you, but for me as a real estate guy, I don't want to do that. I want it to be broken down for me a little bit easier than that. So, these news articles will break this stuff down and they'll show you here's the top US metros for population growth. Another one that I like is the Milken Institute's Best Performing Cities Index. And they go through and they break down stuff like job growth, income growth, household formation, those things. And they rank 200 large US cities in order of which ones are performing the best over the last 12 months. And that's a really interesting place to start, because if you're in the top 50, then you're probably somewhere in the zone. And then you can start to zero in a little closer than that. So that's how we pick like the macro level markets. So we'll go, okay, we want to be in Arizona, Texas, Georgia, Florida, North, South Carolina, and Tennessee. Now we're looking at that census data on what cities are expanding. And now we go, okay, we want to be in Phoenix, Tucson, Atlanta, Tampa, Orlando, Nashville, Charlotte, Raleigh, Cary, those kinds of cities. And then to drill down even one step further, we use the paid data. And this is where stuff gets really pricey, and can cost you about $250,000 a year if you're all in on paid level subscription data. But services like Axiometrics, Reese, which is now part of Moody's, CoStar, MPF, those services have PhD economists that do nothing but analyze and crunch rent data. And some of these are owned by the same companies that own the software that runs your multifamily property. So for example, we use RealPage to manage our properties. And at the property level, it's called OneSite. You move a tenant in, you put in their rent, you sign their lease, it's all done in the system. And Axiometrics is owned by the same company that owns that property management software. So they're directly tied in. I mean, if you do a $10 rent increase, they know it. And they're tuned into it in real time, and they can produce rent growth forecasts going out 3, 4, and 5 years at the sub-market level, almost by neighborhood. But it's not by any sense of the imagination free. It's very expensive. But it's also very helpful data in zeroing in on what it is that you're doing. And, it's why I go back to all the time people say, well, geez, I want to get into multifamily. I've got $1 million on my own cash. I'll just go out and buy something on my own. Why should I split the profits with you guys? And what they fail to recall is that, as a professional in this business, we have access to all sorts of data, access to all sorts of relationships with brokers. And having all of that information is part of the value that we bring. So if all you're doing is just going to city data and that sort of stuff, you're not bringing enough value to your investors. Dig deeper and find better data.
Yeah. Well, I think the people that say that go in with that line of, well, I got $1 million, I'm just going to do it all myself. They're doing themselves a huge, huge disservice. This is a team sport, always has been, always will be. And you're best served, especially starting off, best served doing partner up with someone and leveraging each other's skills to take down those deals. Right. That's one thing that I've always conveyed to many of my students and my mentees is that you always want to go ahead and partner up with someone that knows what they're doing and build and bring value to the table. Bring value to the table. Maybe your boots in the ground and they're not. Who knows? Whatever it might be, right? But bring something. That part is absolutely huge. Now, I know that one of the things that you also love to do is reposition existing properties. And, these days, trying to find properties is a problem in itself. It's hard to find anything old and beat up. I'm not saying it's impossible. It's tough. It's tough these days. But when you do find something, you do find a diamond in the rough, what are some of the things that you're looking for to really predict how, or really drive value so you can really project how something's going to perform after you work your magic on it?
Well, the primary thing is to look at the comps. And so, you could have a property that's totally beat up, but if they're getting the same rent as something that's totally fixed up, you're probably not going to get a lot of value for the extra renovations that you do. So what we're looking for is a delta between what the rental rates are at the property versus what the rental rates are at other nearby properties. And, if you can bring your property up to the same condition as those other assets, what rent can you get? And, we don't aim to be the pioneer. It's always fun to think about like, oh, we've got this beat up property. It's at the top of the comps, but I could put in, $6,000 a unit and we could get another $250 and be at the top of the pack. That's a very risky Lone Ranger style business model, where you might go out there and knock it out of the park, or you might end up with an arrow in your back. So I suggest that for me, we want to not try to be the market leader, but we want to find something that is the low price leader and make it to be a market rate where we're kind of in the same realm as everybody else.
Yeah, yeah, yeah. And are you finding it difficult these days to try to locate those deals, or are you using any special types of methods to try to locate them, or just using the same tried and true type of relationship? Like, what sort of things are you doing?
It's enormously difficult. And yeah, we do rely on that same set of relationships. But the reason that it's enormously difficult now is because this has been a popular strategy for about a decade. It was really easy for us to find stuff in 2010 because there was nobody buying anything. And we could just go out there and basically anything we wanted was not renovated and had a seller that was motivated and didn't have a lot of buyers. But for the last, 6 or 7 or 8 years, people caught on and they've been renovating. And so what you're finding now is these second generation renovations where, okay, they did the exterior and, a third of the interiors. And now all you get to do is finish out the other 2/3. There's just that kind of stuff. That's what's out in the marketplace right now. And so it's a little bit challenging to find those first generation value add properties. And but we're also finding that we don't need to. We can perform adequately for what we need to do on a lower risk model of finding newer properties, maybe something built in the 90s or 2000s even, that just needs a little bit of sprucing up. And with some paint and drawer fronts and cabinet fronts and light fixtures, you can get $100 or $200 or $250 bump in rents. You don't have to go and find a 70s deal and renovate the whole exterior and make it look 80s and do all that stuff. You just don't have to do that to generate a satisfactory return.
Right. Now, are you guys expanding into different asset classes these days? Or are you pretty much trying to stay with your bread and butter?
We're shifting a little bit, I would say. Where before 70s and early 80s product made up the majority of what we were acquiring. Now it's probably more mid 80s to 90s to 2000s is really where we're spending a lot of our time.
But you're staying in multifamily though. You're not going like the
Yeah.
triple net or storage or anything else like that, right?
No, sticking with multifamily, there's, of course, the various real estate asset classes are all in a different phase of performance right now. And, the last thing I'd want to be right now is a hotel owner. The next to last thing I'd want to be right now is a retail property owner. The next to last thing besides that I'd want to be is an office building owner. If you could find me a great industrial property and I knew what I was doing in industrial, which I don't, I might have interest in the industrial sector because I think it's going to do very, very well over the next 10 to 50 years. I think the residential sector is going to be resilient. I think it's going to deflect a lot of damage that was feared, but I think it will do fairly well. The other sectors scare me right now. I just can't think of a good reason to be in those other real estate classes. And I think that while there may be some opportunity because there'll be some major price dislocations, it's going to be an incredible battle to get to the other market cycle peak in that sector.
Yeah.
Whereas with residential, I think it's going to be a little bit easier road to hoe.
Yeah. Oh no. Well, especially with all this COVID stuff that's taken place, it's pretty much cemented the very thing that we were probably talking about before all of it really came to a head, and that office is one of those things that's not really needed. We don't need an office. We don't need to get in our cars and drive to an office every day, but we do it until you don't have to anymore. And then
Right.
once you realize you don't have to do it anymore, and there's actually friends that have done this. They've had numerous offices in Miami, New York, Connecticut, they shut them all down and now everybody's working from home. It's like, why pay the lease? And things are a little slower, but who cares? The business is slow in general, so it doesn't matter to them. And yeah, it's that's just one person out of tens of thousands of businesses throughout the U.S. right now that are going through the same sort of thing, right?
Yeah, and I think that trend is here to stay to a certain extent. I mean, I think people are going to reconvene in office environments, but there will always still be a little bit of a scar that will never heal from that. And
Mhm.
there will always be people left over that will be working from home at a greater rate than what we saw previously. And that's not going to only create dislocations in the office market. It's also creating movement in the residential market because those people are moving from one area to another. And a great example here where our office is based, we're in the North Bay of San Francisco. The South Bay Peninsula has always been the hub of, Facebook, Google, Tesla. It's the epicenter of everything tech. And now that these workers are all working from home, they're scratching their head and going like, wait a minute, I can sell my $2.5 million 900 square foot bungalow in Palo Alto and go buy a 3,500 square foot house with a view in Santa Rosa for half the price. Why don't I do that? Because now I can work from home. And that's going to create an interesting shift in housing patterns in those high cost markets. So New York City, San Francisco, San Jose, Los Angeles, some of those areas, I think we're going to see some long-term pain in the residential and office and commercial sectors. And those people are going to be moving to places like I've already been mentioning. They're going to be moving to Phoenix and Texas and Tampa and Miami and Charlotte and warmer places and cheaper and more affordable places. And that's going to have a big change on more than one asset class of real estate. But if you're investing in residential and you're in the right spot, you're probably going to do just fine.
Yeah, no, 100% agree. 100% agree. Now, Brian, for that person listening right now, what piece of bulletproof advice would you give them if they were maybe on the fence, trying to get into the business or even trying to find an opportunity? What would you tell them?
Geez, well, the my best advice probably is that this is a business it's a fun business to be in. It's satisfying and gratifying to say that you're in this business, that you're a real estate investor, and that you are investing in these kinds of assets. But it all means nothing if you only do it for a short period of time. So it's really important that as you make decisions when you're looking for opportunities, that you make smart decisions and get into good properties, good opportunities, good investments, because it is so much easier to buy real estate than it is to sell a bad deal that you wish you could get out of. So just make sure that you're careful about what you get into so that you can survive this market, to ride out to the next market cycle peak and be successful so that you can have a long-term career that's satisfying, not a short-term one.
Excellent, excellent. Which is why partnering up with someone that really knows your area, knows the business is a great way to also help limit some of that risk too, right?
It is.
Yeah. All right, guys. Well, if you want to reach out to Brian, check out his website at praxcap.com. I hope you got a really good sense on how you can apply real estate and to try to find some opportunities and help build your portfolio. And it's ultimately, I found that real estate is a great way to really cement your future. And I certainly hope that today's interview really helps you see the same thing as well by just finding the right opportunities. Thanks for tuning in, guys, and I'll see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.